what feels like endless tariff and trade chatter and a slew of central bank policy pronouncements, investors may be wanting to focus a little bit more on bottom-up news and company specifics, and the coming week offers a chance to do so. We've got a busy slate of full-year results, first-half results, and trading updates coming up, and names which may be worthy of note for what they say about themselves, their industry, or the economy more widely. Well, they include the following: S4 Capital on Monday the 24th of March, Smiths Group, AG Bar, Henry Boot and Michelmersh Brick on the 25th, Vistry and Virgin Wines on the 26th, and MC Saatchi and Tribal on the 27th. However, the three names that really stand out from the schedule are all exposed to consumer confidence and consumer spending in one way or another, and they're housebuilder Bellway on Tuesday the 25th, DIY expert Kingfisher also on the 25th, and Next on Thursday the 27th. Now, the FTSE 350 retailers sector has slumped to a 12-month low, bogged down by worries over whether weak consumer confidence and dodgy weather will hit the top line, and that increased costs from national insurance contributions, wages, utilities, and raw materials could further dent the bottom line. The major purchase sub-index of the GfK Consumer Confidence Survey may be well off its lows, though, and that could offer a bit of a glimmer of light to Bellway. The builder's first half trading update in February was pretty detailed, so this actual set of results released shouldn't really contain too many surprises. More interest will therefore lie with any guidance given for the whole year to June 2025, not just these half-year numbers. Watch out for comments on, firstly, completions and average selling prices, where Chief Executive Jason Honeyman currently expects 8,500 home sales at an average price of around £310,000. Then look at how input costs shape an anticipated underlying operating margin of 11%, any further cladding remediation and tall building provisions, and the forward outbook, £1.3 billion at the last count, cancellation rates, and also reservation per sales per outlet per week, which rose to 0.61 from 0.43 in the equivalent first half period a year ago at the first half stage. Now, finally, Bellway's got a net cash balance sheet, and that should help to fund dividends. The interim payment a year ago was 16 pence a share, and Bellway eventually distributed 54p a share for the whole year, and the consensus forecast for this current year at full year around, well, that's 65p. Meanwhile, results and updates from Primark owner Associated British Foods, B&M European Value Retail, and Spain's Inditex, which owns Zara and Pull&Bear, all suggest the retail market is far from easy right now, a view backed up by the non-food sales data from the British Retail Consortium. This puts the spotlight on Next, while boss Lord Simon Wilson was relatively guarded in the outlook statement that accompanied January's trading update, though some may interpret that as his skill at setting a low bar which the retailer can then exceed, to the regular delight of shareholders. Next has raised sales and profits guidance 9 times in the past 2 years to help fire the share price to a new all-time high last September. These full-year results to January 2025 will be assessed on the basis of 4 numbers, both for the year just ended and the year just begun. The first is year-on-year growth in full-price sales, which reached 6% in the 9 weeks to 28 December, and where the guidance for the new year is currently 3.5%. Then look at pre-tax profit, where Lord Wolfson's guidance is for £1.01 billion in fiscal 2025, and a minor increase to £1.05 billion in fiscal 2026, thanks in part held back by £67 million in extra wage and national insurance costs. Then look to cash returns. After paying out £258 million in dividends and running £326 million in share buybacks for the last year, Next expects to distribute £276 million in dividends and a further £314 million in buybacks in the coming 12 months. That aggregate cash return of £590 million for the coming year, well, that's equivalent to around 5% of the company's current £11 billion stock market capitalisation. And finally, to Kingfisher's full-year results to the end of January. December's trading update, the sale of the Romanian business, and the start of the latest tranche of the share buyback programme have all combined to give the shares a bit of a boost after last year's slide. The company is a leader in DIY in the UK, France and Europe, with physical stores and an online presence via brands such as B&Q, Screwfix, Castorama and Brico Dépôt. Analysts are looking for a 0.2% advance in like-for-like sales for the fourth quarter and a 1.5% drop for the year overall. On a headline basis, the consensus forecast is for sales to fall 1% for the full year to £12.8 billion, before a 2% increase to £13.3 billion in the year to January 2026. Attention will then switch to the like-for-like trends in Kingfisher's major geographic markets of the UK, France and Poland, before shareholders look to see whether Kingfisher meets guidance for fiscal 2025 and how it stacks up for 26. Analysts currently expect adjusted pre-tax profit for the 12 months of January of 523 million compared to 568 million last year, with a slight gain in the coming year to 543 million. And also free cash flow of 422 million pounds for fiscal 2025 and 400 million for 2026. That free cash flow is funding a share buyback scheme, where Kingfisher is currently running a fifth £75 million tranche, and also the dividend, which is expected to come in unchanged this time around. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.